take a moment to introduce our guest for today, a very popular and well-known name. Today we have with us Ashish P Sommaiya sir, currently CEO and Executive Director of Whiteoakcapital since September 2020. So previously he was CEO with Motilal Oswal AMC for over 8 years, and he started his career and spent over and he most of the time you have seen him appearing on TV channels sharing his thought. And
I think we seem to have lost the host, but can everybody hear me? If you can just kind of respond on the message, maybe I can start talking if you can hear me, because I
we
think,
can hear you, and yeah, we can hear you, sir. You can start, please.
okay, so kind of you. So thank you very much for inviting me here to, speak to all of you, and obliged to see, so many people join in already. Um, but, I think couple of points I want to share about, the topic. I think this is basically this what I've written here, thrive in gray, is actually more like a my observations. So like Prince mentioned, I mean, I have not been a portfolio manager myself, but I've been engaged with the asset management industry for say more like 20 to 23 years. And what I've seen is, over these so many years of interacting with financial advisors, mutual fund distributors, private bankers, wealth managers, and of course, more importantly, engaging with investors. So one of the perks of my work, or one of the most enjoyable aspects of my work, is that I get to travel a lot, maybe sometimes 12 to 15 days in a month in India, or maybe sometimes even abroad, and meeting equity investors across geographies. So I think that is, it gives a great opportunity to understand how people are thinking in different types of, market situations, and how people conduct themselves. So I had few observations over the years, and one of the things which I learned is that when we talk about investing in the stock markets, the most commonly asked question is what do you think about the market? Like at any point in time, you find people wondering as to how to think about the market, what is the expectation going forward, and it's there is a whole industry out there uh, which thrives on telling people what is expected in the market in the next 3 months, 6 months, 1 year, 3 years, 5 years. Now, in reality, obviously, all of us manage products which are supposed to have certain outcomes over a number of years, may it be fixed income, may it be equity. And then, of course, depending on the suitability of those services or products, investors might choose to invest in them towards their goals. So the key point is that everybody is investing for their goals, and these goals are over 3 years, 5 years, 10 years, 15 years, 20 years. But I think that's the more structured, process oriented, long term part. But definitely, because the stock market is a key thing to key, stock market is something key to negotiate. I think human beings find it very difficult to negotiate stock markets, and I think stock markets, because the return comes by participating in the stock markets, it's a necessary evil to understand stock markets. But I think that is where a lot of people really, really tend to stumble. And whatever the host has been kind enough to pin one of my original tweets and videos in which I'm talking about this topic. Uh, so where did this come from, and why did I write, Thrive in Gray? The key point is that whenever somebody asks, or whenever somebody is trying to figure what is happening in the market, they are basically looking for certainty, or they are looking for some kind of black or white kind of answers. And very, very often, the most commonly asked question is, what do you think of the market? Is it at the peak? Is it at the bottom? Is it cheap? Is it expensive? And I think these are certain things for which there are no answers. So let me just put it this way, that for instance, if you look at it vis-a-vis the long range past, the market is at its peak right now. And if you look at it vis-a-vis its long range future potential, then probably the market is close to its bottom right now. Those of you who studied engineering, or electronics, you understand that, when you talk about the electric current, it moves like a sine wave. And stock markets, the index also is supposedly, visualized as if it's moving like a sine wave, in the sense the market is also assumed to have a series of crest and trough. But when you see the electric current, it's a sine wave, but the center line is a flat line. And in the stock market, also there is a sine wave with crests and troughs following crests and troughs. But the only difference is that the center line is probably 45 degrees inclined upwards. So that's why I said that, most of our time goes in trying to figure whether the market, what will the market do going forward, and whether it's at the peak or the bottom. And the thing to perspective to keep in mind is that if you look vis-a-vis the long range past, the market is at its peak. And if you look vis-a-vis the long range future, the market is at its bottom. So this is just one such question which actually has no answer, but human beings spend a lot of time looking for answers. And this is true of stock markets and of life, because the human mind basically looks for sorting things, looks for classifying or slotting things. We want to understand everything as right or wrong, good or bad, left or right, black or white. We try to classify things, and we are very, very deterministic. So we want to be able to understand whether ye jo bhi hua, is it right or wrong? Is it good or bad? Will the market go up or down? So I think stock markets, and there are many things in life also, many parallels. It's not possible to classify these things, and there are many, many things जिसके जवाब नहीं होते हैं. So I'll give you another example. किसी बड़े बुजुर्ग ने, या some learned men have said that दुनिया गोल है. For the longest point in time, I didn't understand what is the meaning of that. Now let me tell you in a very pedestrian fashion that if you look at the globe, the US is to our left or to our right. Now obviously there's no answer to this. If you travel from Bombay to the East Coast via, say, Etihad, Emirates, or British Airways, then obviously it's to our left. And if you travel to the West Coast via Singapore Airlines, then obviously it's to our right. So same way, market ऊपर जाएगा या नीचे जाएगा, market अभी bottom पे है या peak पे है. There are many of these things जिसके कोई जवाब नहीं होते हैं. And why human beings struggle to operate in the stock market is because human beings are deterministic in nature. We want to slot everything. For example, some relationship doesn't work out. Our important employee leaves us. Something goes wrong. We want to understand, why did this happen to me? But there are no definitive answers. Human beings love to look for answers. So much so that if you look at, for example, today if the market falls 2%, then by the time the market closes, you will find a lot of talking heads who will give you a perfectly plausible explanation of why the market fell 2%. And then tomorrow, if the market rises 2%, then you will, by end of day tomorrow, you will get a perfectly plausible explanation of why it went up 2%. Let me give an example. In October 2021, index was 18,490. And there were a lot of explanations given that, okay, look, India is doing great, we are decoupled, we have nothing to do with China tech and so many things. And there were a lot of explanations about India's Amrit Kal and why we deserve to be 18,500 and making new highs. So when it was 18,500 making new highs, you got perfect explanations. But then by May 2022, we went to 15,200. When it went to 15,200, again, you got perfect explanations. Look, oil is 125 rupees 83. US is raising rates. There is a war out there. Now you digest all those explanations, but then November 2022, you are at 18,900, again making new highs. And then when it makes new highs, now what? I mean, what happened to all those explanations? So the point is that human beings love to seek explanations. Human beings love judgments. Human beings will function better if there is certainty. But the reality is that in the stock markets, nothing is deterministic. You don't have perfect explanations for anything, although we try to give perfect explanations. The reality is that there is no explanation. There is no right or wrong, good or bad, left or right. In fact, what I've learned is that there is only context and there is perspective. So at any point in time, if you will do much better if you are probabilistic in your thinking rather than being deterministic. And instead of looking at explanations, if you look for context and perspective, then I think you are more likely to be a successful investor. And that's why I said, why did I write thrive in gray? The reality is that just like life, it's true in stock markets also. There's nothing called black or white. There is only shades of gray. So as an investor, if you are comfortable living with uncertainty, and if you are somebody who can understand and accept that there is no black or white, there are only shades of gray, then I think you can function much better. The more the time that you spend looking for certainty, the more the time you spend looking for perfect answers or explanations, you're going to go further from the reality. That's why I also mentioned that, it's not, we don't need, it's better not to be deterministic. It is ideal to be probabilistic. And only if you're somebody who accepts uncertainty, only if you're somebody who is willing to live in gray, only then you can be a probabilistic thinker. If you classify everything as good, bad, right, wrong, left, right, up, down, then you are very, very deterministic. And people who are very, very deterministic cannot be disciplined, cannot be process oriented, they cannot be probabilistic. One of the key tenets of doing your financial plan is to do your asset allocation. Now, people who follow asset allocation are obviously probabilistic thinkers, right? I mean, if you were so deterministic, then you would put 100% debt, 100% real estate, 100% equity, those kinds of things. But what is important to be a successful
Asha, if you
investor?
can
What is
hear
important to
me,
make a
you're
good plan? Yeah. Hello.
yeah, right now it's fine. Yeah.
Sorry, I didn't get you.
Sir, you can go ahead,
Sir,
sir. It's
we
clear.
lost you last 30 seconds. I cannot hear you, so I thought
Okay. Yeah. My
uh,
apologies. No. So I was just saying maybe I'll take a pause and just sum up basically. The key thing which I wanted to say is that to be a successful investor, it is most important to be probabilistic. It's most important. Why did I say thrive in gray? Is because if you're someone who's looking for black or white, then you're going to find it very, very difficult to negotiate markets. But if you're someone who is probabilistic, say at any point in time, if you think that, okay, this can happen, but yes, there is a chance something else also can happen. So if you're open minded, if you don't get into judgments and don't jump to conclusions, you're more likely to enjoy the process of investing. You're more likely to be successful. Let me just give you one last example before I hand it back to you. If you were to compare it with, say, cricket, for instance, right? Like a lot of us in India, we love watching cricket. Now, and in cricket, the most epic is a match between India and Pakistan, for instance, right? That's like a iconic rivalry. Now, when you're watching an India-Pakistan match, let's say it gets into a real tough spot, what happens is that with every over, or in fact with every delivery, you're likely to make a conclusion, right? I mean, one delivery is bold and it goes against us. We say, oh my God, we are going to lose. ये लोग पता नहीं क्या team बनाते हैं. We are just, we just can't succeed. Then another good delivery or another good over, we're like, oh, okay, we are back in the game. Looks like we'll make it. Another bad delivery, another bad game. So what happens is that when you're watching an India-Pakistan match where you're emotionally involved and heavily invested in the outcomes, and you want to conclude that, okay, we will win. So what happens is that every ball, every delivery, or every over, you are jumping to conclusions. So you'll never enjoy the game because you're very, very invested in the outcome. You're not open-minded about it, and you anyhow want your team to win. And every good or bad delivery, you're making some or the other conclusion. You're passing some or the other judgment. But on the other hand, there is another iconic contest, which is the Ashes, where England plays Australia. Now, if you are a connoisseur of cricket, you will be able to watch England and Australia with an open mind. Correct? I'm sure people do have favorites, but the reality is that you will watch the game for its quality. And with every passing delivery or every passing over, you're not jumping to conclusions, right? You're watching the game open-mindedly and you're observing the quality of the game. You're observing it for the intricacies. You're observing it for the nuances. In an India-Pakistan match, probably post-match analysis, you will capture some nuances. But while watching the game, for every over, every delivery, you are making a conclusion and you are missing so many nuances. So in an England and Australia match, it's relatively easier for you to keep the context and the perspective in mind. But when India is playing Pakistan, it's very difficult for you to think of context and perspective and nuances. You're most likely to jump to conclusions. So that's the key point, that when you're investing in the stock markets, I think it's better off if it's like a England-Australia match for you, where you're open-minded, where you're observing context and perspective, where you understand nuances, you're likely to do much better. So I think that's the essence of what I said about thriving in gray. It's very, very important to get comfortable with gray and not to slot every situation as black or white, good or bad. I think then you can function better. So I'll take a pause here. Sorry for a long-winded monologue. If there are any questions on whatever I've spoken or anything else, most happy to answer that.
Like to touch upon this, sir?
I beg your pardon? Sorry, you're breaking up. I'm not able to understand some of the things you're saying. Yeah.
Okay.
Please, can you repeat?
Is
My apologies.
yeah, is it better, sir?
Yes, please. Please go ahead.
So,
No, I can't hear you. Can everybody else hear Prince?
action use, and if you are
Sir, am I audible?
Yes, Kaushik, you are very clearly audible.
Okay, sure, sir. Sir, I'll take it from here. Sir, can you any financial planning for a person is more important than even telling equity is more important. So
Of course.
what's your call on when someone can you explain any case that you have recently come across where how have you taken part in the financial plan and how was your career designed from the day one till date? Because I started following you from Motilal days, sir. So can you show me how was your path and what was your learning in each and every life too?
Yeah, so I presume, so, look, obviously I'm not a financial planner. In fact, since you're asking me about myself, I'm actually a chemical engineer. I used to work in a factory. For about a couple of years, I worked in a factory where we used to make, polyvinyl chloride PVC compounds, which goes into wires and sheathing. So I'm a chemical engineer, but, postgrad in, specialized in, say, polymer science. After that, like I said, I worked in a factory, and then, uh, I got exposed to stock markets because of my, when I was doing my engineering, a lot of my seniors, people who were in my hostel, uh, you know, got exposed to stock markets. So after working for a little bit, I did my postgrad in finance. So somewhere in 1999, I was a trainee in ICICI, and that's ICICI Mutual Fund. So from there on, I've been engaged with only and only the mutual fund industry. So now, when you say financial plan, I mean, frankly speaking, I am not somebody who is supposed to make investors financial plan. I think there are, clearly pros out there, professionals, registered investment advisors, financial planners. They are obviously supposed to do it. And if you ask, at some point in time, I think couple of years back, I was asked about how I invest. Uh, Frankly, I don't think a lot of people should take my advice because, largely speaking, my risk appetite or my goals or my preference for investing, largely speaking, because of my risk appetite or my goals, I'm largely a equity and a real estate investor. But I think people should obviously consult some of. I mean, either people qualify themselves or learn themselves, or they obviously have to consult some kind of investment advisor or financial planner who can make the plan for them. As far as I am concerned, obviously I'm part of the industry for very, very long. So I've had the good fortune of working with some remarkable people. And I think that has also shaped my conviction or my preference for investing in equities. But that may not be everybody else's experience or journey. So, they have to obviously follow what works best for them.
Thanks, sir. Sir, can I understand on your investment philosophy, like more than your investment philosophy, what was the story behind the White Oak coming in, and how are you part of White Oak, and what was the story behind this, sir?
Yeah, so I am a professional CEO. I've basically, broadly speaking, first 12 to 13 years I worked for ICICI Prudential Mutual Fund. Then for 8 years I worked for Motilal Oswal. So large part of my career has been these two organizations only. September 2020 is when I joined White Oak. So I am a professional. I'm not the owner, founder, or in any manner responsible for founding Whiteoak. In fact, Whiteoak is founded by a very reputed and illustrious fund manager. His name is Prashant Khemka. So Prashant founded Whiteoak in 2017, and he's well known amongst investing circles because prior to founding Whiteoak, he was chief investment officer for Goldman Sachs Asset Management for their India equity, not only India, in fact, also for global emerging markets. So he worked at Goldman Sachs for 17 years. First 6 years he was with their US equity team, and then for 10 years he was, the lead manager and CIO for their India equity strategy. And apart from India, along the way, he also got elevated to manage global emerging markets. So there is a team of about 37 investment professionals. Lesser known fact, White Oak is one of the larger foreign portfolio investors investing into India. So we manage money for some of the large sovereign wealth funds, pension funds, um, high net worth investors, family offices. So there's over 3.5 billion of global money invested into India, which we manage, and about 1.5 to 2 billion is domestic, which we manage for local Indian investors. Now, if you really ask me, when you talk about investment philosophy, it's slightly difficult to narrate it in short, because generally what happens when you talk about investment philosophies, there again, a lot of slotting tends to happen. So managers like to describe themselves as large cap specialist, small cap specialist, contra manager, value manager, etc. The reality is that all of these are uh, narrow segments of the market. So, for example, if you look at BSE 500, BSE 500 is 96% of the total market cap. And BSE 500 is not large cap, small cap, growth, or value, right? BSE 500 is everything, that's the whole market. So, if you want to beat the market, then your portfolio has to not be a very, very narrow. If you want to beat the market consistently, that is, then your portfolio can't be a narrow sliver of the market. So, we are a blended style, growth oriented manager, I would say. But broadly speaking, our portfolio has everything. We invest across market caps, across styles, and across sectors. So difficult to slot it in any one crack corner or crevice of the market. It's a broad market strategy, and we generally manage only multi-cap. So it's a broad market strategy, and its aim is to beat BSE 500. That's what, in short, we try for. I think there is some challenge with your line. So the host's
Am,
line, I
Sir,
think, is
am I
not coming
audible?
across. Maybe you can throw it open to the audience. Maybe then they can engage because we're not able
Sure.
to hear at least the host's questions.
Sir, am I clear now?
Yes, Kaushik. I can hear you, Kaushik, but not Prince.
Oh, okay, sure. Sure, sir. Sir, I just wanted to understand how is your fund managing the risk? Because foreign money coming into India and then investing in India, they are also exposed to currency risk, right? So what is the strategy behind this, sir, and how are you managing the risk? Like what is the clear picture on that side?
No, so I see it's like this. If somebody decides to invest in India, it's obvious that they are exposed to currency. I mean, people may choose to hedge it if they want to. That depends on what is their mandate and what type of portfolio they are running. As far as we are concerned, uh, every single dollar which comes to us is invested in underlying Indian equities. And obviously, if you're investing in Indian equities in a single country, then yes, you are exposed to the rupee. And every time I meet global investors or foreign investors, what you asked is a common question that, oh, we can invest in India, but the rupee tends to depreciate. The reality is that, I'll give you an example. I mentioned that my colleague Prashant, who's our founder and also the owner of the firm, he's been managing Indian equity since 2007 now. I'm not trying to tell any track record or anything, just giving you an example to understand this whole currency thing. The reality is that in dollar terms, it would be about 12 to 13% compounded. In rupee terms, his track record would be about 16 to 17% compounded. So obviously, whatever data or whatever numbers are reported after factoring in the fact that the rupee depreciates 3-4% year on year. The long period average, I think over 20 years, the average is that the rupee loses 3 to 4% CAGR versus the dollar. That's a reality. The problem or the pain point which it causes global investors is that obviously it doesn't depreciate 3-4% in a straight line. And there are few years when it does nothing, and then there are years when it suddenly depreciates 10%. So I think if somebody is a sufficiently long-term investor, then I think they will tide over it, right? And by the way, if you look at it from a global investor's perspective, let me tell you that India, after US, India is the best performing market globally. I'll repeat that. Globally, after US, India is the best performing stock market in US dollar terms. So if you take last 5, 10, 15 years, after US, India is the only market or the second best performing market in US dollar terms. And by the way, it's better than China and any other market that you can really think of. So people who are investing in India are obviously investing because of our growth potential, and not just growth potential, because also we have very sound regulatory framework and very, very sound capital markets. Like China has blown the lights out when it comes to economic growth, but their stock market has not delivered what their economic growth tends to portray, right? Because all economic growth doesn't result in appreciation in the stock markets. For economic growth to manifest itself in stock market appreciation, you need institutional framework, you need market structure, you need minority investor protection, you need thriving private sector enterprise. Many of these things are needed. So, I've given you a long answer, but people who are investing with us are obviously investing deliberately to gain India exposure. Whether to hedge the currency or not is their choice. But we at a fund level or as a manager, we don't hedge the currency. We straight away deploy money in India and in Indian rupees. Yeah, is there a next question?
Sorry, sir, we lost you in the last part, but I would go ahead with the question. Sir, why do you think India is a sweet spot currently, and what growth triggers are you seeing? Is it just because of the population and demographics that we are in, or anything that you are looking at as India is a very big sweet spot to the any other person in outside the country?
See, I think, frankly, a lot of, I'm sure that most people on the call have, or on the spaces have been through. So I mean, I don't want to bore everybody or labor everybody with, India shining kind of story, really. But to do justice to your question, I'll just highlight 2, 3 things. Part of what I mentioned, one of the key reasons why people look to invest in India, part of the reason I already explained that, there could be other areas of the world where there is economic growth, but the reality of market experience is that all growth doesn't result in stock market appreciation. So, like I mentioned, one of the strongest points in India is the institutional framework and the capital market framework, minority investor protection, respect for capital, respect for private capital, more importantly, governance frameworks, and many other things. Now coming to drivers, I think yes, one of the key things is demographics, and I think what role demographics plays, we need to think of it logically. That somewhere in the next 5 to 10 years, India will account for almost 30% of the world's working age population, and working age population is what contributes to consumption as well as labor, right? So, and the world always needs some part of the world. Let me put it differently: that returns are always made on growth. So people will invest where there is growth. But the key point about growth is that growth is relevant only if it comes at scale. So there will be many countries who might grow at 5, 6, 7, or sometimes 8%. But there are no 3.5 trillion countries which are growing at 5, 6, 7, 8%. Correct. So we all talk about demographics and we understand demographics. But the demographics basically ensures or is likely to ensure that we will grow, but not only grow, we'll grow at a scale. So I think this is something which is very, very important. And I think in the foreseeable future, the problem for the world is that the countries which contribute the most to the growth of the world and the countries which are the richest in the world, they all are going to become older and older, and none of them are going to be able to reverse it, right? The only country which can manage its growth and its scale is the US. That is because US very smartly encourages immigration, and not only immigration, they encourage immigration for the best of talent globally. But I don't see anybody immigrating to China or to even Italy or Spain or to South Korea or maybe Taiwan or vast parts of Europe or even Russia or anywhere, or even Japan for that matter, right? So the problem for the world is that the richest countries in the world and the countries which have been contributing the most to the growth of the world, they all are aging. So where will the growth come from? correct? And the last thing which I'll tell you, if you're looking at numbers, you should always keep an eye that what proportion of the world's growth are we contributing. So I'm not some economist, but I can give you back of the envelope numbers. In 2019, see, the world GDP or the annual output of the world would be about 90 to 95 trillion. In 2019, it was about 90 trillion. In 90 trillion of the world's annual output, the US was 22 trillion. On a base of 22 trillion, the US grew 3.5%. China was 16 trillion, maybe they grew 5-6%. So two countries put together must have grown about one. World grows 3% in a good year. So let's say the world added 2.5 trillion or 2.7 trillion. Now, by in 2019, the reality was that out of this 2.5 or 2.7 trillion, only two countries, China and US, contributed 65 to 70% of the world's growth. So it's a no-brainer why they are the biggest investment destinations in the whole world, because they contribute 65-70% of the world's growth. This was in 2019. But what is it in 2022, for instance? And by the way, in 2019, India was 2.5 trillion. And in the financial year 1920, we grew 3.7%. So imagine in 2.5 to 2.7 trillion of the world's incremental output, India's contribution was 100 billion in 2019. But what is it in the year gone by? In the year gone by, India would have not contributed some 3-4% of the world's growth. It came in the newspapers. We contributed nearly 20% of the world's growth because we were no longer 2.5 trillion growing 3.7%. We were 3.5 trillion growing about 6%. So we suddenly added 250 to 300 billion to the world's output. And in a year like 2022, that 250, 300 billion was almost 20% of the world's growth. So what proportion of the world's growth do you contribute will determine who wants to invest and how much they want to invest, because investment will always chase growth. Why? Because returns are always made on growth. So I think growth and growth at scale, this is something which is important to watch out for.
Sir, I have an add-on question to this. Sir, if India is in such a sweet spot, why don't people are like investing blindly on the index funds than going for an equity exposure? Index funds is not a safer option, or like what's your thought on this, sir? Because I have seen, like I started following you like 8-9 years previously. I've attended one of your face-to-face event that is called EMI to Wealth Creation, or I'm not remembering exactly, where you focused on Nifty 50 companies and started talking about how HDFC created wealth and how was the story behind
Mm.
that. From that day, I've seen you more onto a number side of the person.
Mm.
So can you give on some clarity on this one, sir? My question, like, why not index funds than go to an mutual fund or anything?
See, it's like this. It's a, I mean, frankly, it's about people's beliefs, convictions, and preferences. So I'm not in any camp that you should invest in only in active funds, don't invest in index funds, or for that matter, the opposite side, that invest only in index funds, no active funds will do well. I think two or three things where, and I myself had some involvement in creating index funds. Now, what happens is that whenever you talk about index funds versus active funds, the discussion very, very quickly degenerates into a debate about alpha, lack of alpha, etc. I personally think that's a wasteful debate because it's a no-brainer. By and large, we should assume that investors are smart. Never assume that investors are not smart. In fact, I find that there is a lot of discussion which presupposes that all investors are gullible and they don't know what they're doing. I am never in that camp because I have in my lifetime I must have met lakhs of investors, if not millions. And I do public speaking for a living. In any given week, I may be personally speaking in audiences and banquets and auditoriums. In any given week, I may be speaking to 400-500 investors and then separately meeting them and talking to them. So I generally never go by any such assumption that investors don't know or they are gullible or anything like that. So I personally find that if active funds don't beat the benchmark, it's a no-brainer that slowly everything will migrate to passive. I mean, there's nothing to debate. But what do we need to keep in mind? 2-3 things we should keep in mind. Is there scope to generate alpha? I think that is what you should keep in mind. Look, All discussions about active and passive, people will talk for 3-4 minutes. In the fifth minute, they will land up with US examples. So if you see on social media and any blog or anywhere, everything about the passive funds is quoted from the US. Now, that's where I think this argument becomes futile, because the US market and India market has absolutely no connection. I mean, they are not comparable at all. And let me give you a few statistics on this. In the US, in last 25 years, the market cap has gone up 3 times. Last 25 years in US, market cap has gone from 13 trillion to 40 trillion. This is a year-old data, but and now it might be lower. But in last 25 years in the US, the market cap has gone 3x. Do you know that when the market cap has gone up 3x, the number of listed companies has become half? So what has happened in the US? Market cap went up 3x, but number of listed companies became half. What does it mean? It means that a lot of small cap, mid cap, micro cap companies have gone out of the market. Where did they go? In this same time frame in the US, the corpus of buyout funds, all these SPACs and all the fancy words you hear, the buyout funds corpus has gone from 0 to 2 trillion. So what has happened is that in US, more and more part of the market, they will tell you it has become institutionalized. That's not true. It has become institutionalized is a fact, but institutions have been putting 60-70% of their money in alternate products, which is basically private equity, crossover, turnaround funds, and SPACs, and all these kinds of things. So in India, there are more listed companies than US. Second thing, in US today, if a new company gets listed, what type of company is it likely to be? It will obviously be something to do with space or biotech or some new fintech or something like that. In India, shoemakers are still getting listed. US is $70,000 or $75,000 per capita income. We are $2,400 per capita income. Bikaji Foods and Campus Activewear is still getting listed in India now, right? So the stage of evolution of the markets is not comparable. India is not in a situation where number of micro cap, small cap, and mid cap companies are going out and everything is becoming mega cap. No. In India, when an IPO comes, the market cap is 1,000 crores. In US, Uber got listed at $75 billion. Now look at it this way, that if what is happening in US, institutionalization, institutions putting money in alternates. So in the US, people will tell you there is no alpha. You know what is the reality? The reality is that in the US, the alpha has gone to the private market. And so retail investors are told put money in passive, and institutions and rich people are told put money in alternates. So the alpha in the US has migrated from public to private. In India, the private market is 15 years old. And in India, bulk of the economy is not even reflected in our market. So I think that we should have discussions which are to be. That's why I said, when I say thrive in gray, why do I say that? Because everybody very quickly jumps into active versus passive. The world of investing and the stock market is far more nuanced than what we would like to believe. We cannot just copy paste frameworks from US into India. I also know that in India, alpha is elusive, it keeps rotating. But in the last 3 years what have we witnessed in India? For the first time, we saw 3.7% GDP growth in 1920. In 2021, we saw minus 7.5%. And today we are back to pre-COVID levels. Even before pre-COVID, we were continuously slowing down. So India's economic trajectory of last 4-5 years, what happens to active managers when economic performance shrinks and goes negative? When economic performance shrinks, obviously corporate performance narrows. Obviously the market performance will narrow. In India in 2018 and 19, 80% of small cap companies gave negative returns, 60% of small cap companies, mid cap companies gave negative return, half of Nifty companies gave negative return, but the Nifty closed 5% up. That's what happens when economic performance narrows, corporate performance narrows, and index performance also narrows. So I don't think we can start making conclusions about where to invest. I think both will coexist. And I think, here also I will say that making conclusive or deterministic statements that this will only work, that will not work, I think it's too theoretical. And copy pasting foreign frameworks to make conclusions about India's markets is also kind of going to be misleading. Also, it can make you draw wrong conclusions.
Thanks, sir. That was literally mind-opening for me. Sir, I just have another add up onto the question, and it framed over when you were speaking to me. Sir, I just wanted to understand, is this something going to happen, similar thing in India? Are we also moving from the public listed that we also start moving to private sector?
Yes,
Because yes,
it
sir.
will happen. I'm not denying that. I only said that it is too premature to conclude that we have become US. Will our market also follow that trajectory? I have no doubt it will. But you must always remember one thing: never worry about index capturing the market before the market captures the economy. That is why I said we are not $75,000 per capita income. We are not seeing $70 billion IPOs. And we are not seeing space and biosciences companies getting listed. We are seeing somebody making savories and snacks and shoes getting listed now. So remember, our market doesn't capture our economy. It's too soon to conclude that our indices capture our entire economy, right? So we will definitely go the US way. We will also see passives rising. I have no doubt about it. But the moment, and yes, we will also see private markets growing. We are already seeing it in the last 10, 15 years. I have no doubt we'll go that way, but I think it is some way off. And hence, you should hold off any conclusions.
Great answer, sir. It was again hats off for that answer, sir. Is it
Would you
like
like to open it to the audience because
yes,
we've
sir.
gone on for too
We are
long? Yeah.
yes, sir. Anyone wanted to ask the question, please put a request so that we'll approve it and you can directly talk to the sir. Sir, in the meanwhile, we have one question from our audience. Sir, what are the themes that you're currently looking or sectors that you're looking, sir?
See, I mean, like I mentioned early on, we are not a thematic or sectoral investor. If you open our portfolios, you will find we are invested in pretty much every sector. Last year has been a very difficult year for us because we believe in investing in companies with very high governance. And generally, we find that companies which are into commodities and energy and utilities, etc., high preponderance of state owned enterprises, high preponderance of these complex conglomerates. So that's the only thing which we don't invest in. And that's the reason why I think last year was difficult. But on your question, we invest across every sector. Now, since you asked me about India's growth, and since we did discuss about demographics, and I don't want to make any motherhood statements, but I'll tell you something which is directly correlated with your point about India's growth prospects, which is that when per capita income rises, there is some simple arithmetic that the rate at which the GDP grows, per capita income grows faster. Obviously, because population doesn't grow at the rate of economic output, right? So typically, what would happen is that when GDP grows, per capita income would grow faster. But when per capita income grows, you will find that the disposable income also grows disproportionately faster because when we are $1,000 per capita income, let us say $800-900 is the cost of roti kapda makan. But then over the years, cost of roti kapda makan will rise at the rate of inflation. But per capita income will obviously in real terms, it will rise only if it is rising more than the inflation. So in last 10 to 15 years, India's per capita income has gone from $1,000 to $2,400. And I'm quite sure that the cost of roti kapda makan, if you take illustrative numbers, might have gone from $800-900 to more like $1,700-1,800. So when per capita income grows from 1,000 to 2,000, disposable income might have gone from 100, 200 all the way to 400, 500. Now, when disposable income has gone up, so what is happening is that in the next 10 to 15 years, maybe next 10, 12 years, we'll go from being a lower middle class country to more like a middle class country. So from 2,500, 2,400, you go to say $6,000, $7,000 per capita income. The good news is we are not the first country to traverse this journey. The experience of the world and the history of the world seems to suggest that when countries go from lower middle class to middle class, the priority of the people is to look better and to live better and to plan for their future. So when per capita income rises, what tends to grow the fastest is industries and sectors related to saving, investing, and capital markets. And the second is industries related to discretionary consumption. So I think this is what the history of the world seems to suggest. This is not my sectoral recommendation or something. We invest across sectors, but I think whatever you asked me is a natural fallout of the previous conversations. So I thought that I should just highlight that.
Thanks, sir. Thanks for that. Vinod, you can go ahead with your question.
Am I audible, sir?
Yes, sir.
Sir, my questions are two questions. One is how to check management quality and how to do bottom up approach. These are my two questions, sir. Thank you.
See, it's a very, very broad question. I mean, there are books and books and books written on this. So, very, very difficult to answer like this in short. But when you talk about bottom up, let me tell you what it is not. So, for instance, the previous question, I was asked that, what sectors to look at. And then I gave a narration of, per capita income growth and, changes in habits. And hence, I drew some inference about discretionary consumption, etc. Now, clearly, that is not bottom up, that is top down, and that is macro based, correct? So, bottom up is opposite of that. Bottom up is basically when you say that, okay, I'm not starting my discussion with GDP and per capita numbers. That is just the economic environment that one seems to be operating in. But when you talk bottom up, you basically start by putting some filters and screeners, and you're looking for certain types of companies, or you're looking for ground up. When you are, let us say, doing field trips, when you're studying certain data, when you're following some news flow, when you're following some activity on ground, you chance upon certain businesses or certain companies, or when you look at certain filters or screeners that, okay, what type of companies are showing growth, which type of companies are successfully converting profits into free cash. So when you look at all these kind of bottom up parameters, agnostic of top down economy and macro and stuff, that is where bottom up would start. It would start at a company level, correct? And it would involve all types of fundamental analysis, most important part of that being that you are hypothesizing the future prospects of the company, not in macro terms but more specific terms, that what type of sales the company will do over the number of years, what type of revenue it will generate, what type of cost it will incur to produce that revenue, what type of free cash flow it would generate, what is the present value of all those free cash flows. And then you come to your own understanding of how much the company should be valued at, and then you compare that with what the market seems to be showing as the value of the company. And if you think that it is not sufficiently priced in, then you would look to buy that. So difficult to give a perfect answer. I would recommend that you read some books on this whole topic of fundamental analysis. And management quality is of course one of the key things to look for when you do fundamental analysis, because if you just buy a business purely based on its numbers, and then you're just being very, very left brained about it. But if you look at the softer aspects, what type of management it has, what is the credentials, what is the track record, how do those people conduct themselves, how do they treat minority investors, there are many things to look for. So I'll just try to answer in a short capsule, but let me tell you, I have not even covered 1% of it. Very, very deep subject. So I would recommend that don't go by what I'm saying, but definitely read up on it if you're interested.
Thank you, sir.
Thanks, sir. Sir, we have a question from one of our audience. He's asking why you believe portfolio construction over stock picking. And another question add on to that is that is it portfolio construction so important for a lifestyle?
No, see, portfolio construction has nothing to do with lifestyle, really. I mean, maybe you're really, alluding to asset allocation or financial planning level portfolio construction. Yes, that definitely has got to do with life goals and ambitions and aspirations and risk return tolerance, etc. But I'll stick to the former part of the question, that why do we think portfolio construction is more important than stock picking? It's not about more important. I would put it this way, that if you're a professional manager who has to beat the benchmark, see, 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 see. I think I got dropped off, right?
Yeah, the spaces got dropped on its own, sir. So
Oh,
apologies
so
for that.
sorry. So what did you last hear? I was responding to this thing about why portfolio construction is a science. I don't know what all did you hear and where I got dropped off. I think I was talking to myself all alone quite passionately, and then I realized that I am just talking in vacuum.
So you can
Sir, you
take from the beginning to this question, sir. In case we have heard, the repeat will also help us again listening to the same thing.
You know, I think the previous question before I mean all of us got dropped off was about what is the importance of portfolio construction versus stock picking. And I was just saying that a lot of discussion on stock picking in our country is about folklore of very, very famous people. Like, you know, people say that in 1980, if you bought 10,000 rupees worth of Wipro, it would have become few thousand crores or few hundred crores. And then people quote a famous investor that if they when they bought this, then they made few hundred crores, etc. Now, I think a lot of survivorship bias out there in all those examples, which I call folklore, and that doesn't happen with the average investor. The average investor can only stick to the market returns or hopefully do slightly better than the market returns. Now, when you talk about market returns, and you know, one of the most popular vehicles for investing is say mutual funds or portfolio management or whatever that you subscribe to. Now, why do you see that every year or 2 years the best performer is a different manager or a different fund house? What is the reason? I'll give you a few examples, and that's will lead to this thing about portfolio construction. If you see 2019 and 2020, everybody with a defensive portfolio did very, very well. So if you had IT, FMCG, pharma, you're a star performer. But in 21, 22, everybody with a value biased portfolio, cyclical sectors, state owned enterprises, they did very, very well. And the guys who did very well in 2021, the guys who did very well in 21, 22 were laggards for the previous 7 or 8 years. And now suddenly they became the star performers. Now, today, if you start buying everybody who did well in 21, 22, you can imagine what is going to happen in 23, 24. As they say very famously, you got to shoot where the rabbit will be. You cannot shoot where the rabbit is. So the biggest problem is that winners keep rotating. Why do winners keep rotating? Because when macroeconomic conditions change, a different segment or a different sector of the market comes in limelight, and what was formerly in limelight kind of goes out of fashion. So winners rotate because managers tend to exhibit some biases. They prefer certain style of investing, they prefer certain market cap of stocks, they prefer certain sectors, they prefer certain types of companies, and the market makes a monkey out of everybody. So market is not growth or value, contra or cyclical, large cap or small cap. BSE 500 is everything. It has all types of sectors, it has all types of stocks. So if you are somebody who aims to beat the market consistently, look, for short term, you can beat them. Anybody can beat the hell out of the market in the short term by saying, "Acha, I'll only buy small cap." And if small cap does well, they are in a they are in an aeroplane which is just flying. If small cap goes out of fashion and large cap does well, the best performer will suddenly become the worst performer. So what happens is that people performance keeps rotating, winners keep rotating because the market keeps rotating based on macroeconomic circumstances. Now, if you are someone who wants to beat the index consistently, then you cannot be operating in some narrow segment of the market. You cannot be operating in only one market cap or couple of sectors or couple of styles. If you want to beat the market consistently, portfolio construction becomes as important as stock picking, because if you want to beat the market consistently, you should realize that a portfolio is not a list of stocks. When you assemble a list of stocks, you have to remember that there'll be some stocks in your portfolio which get impacted in a certain way by macroeconomic changes. And those very same macroeconomic changes impact another bunch of stocks very, very differently. So there is an interplay within the components of your portfolio also, depending on how macroeconomics change. That is why I say that stock picking is one part. Stock picking is very important. But if you are somebody who is tasked with beating the benchmark, then portfolio construction becomes equally or more important. That's the limited point.
So, Ashish, when the voice got dropped, I was asking you, I was quoting one of your presentation in one of the forums where you said if a person who is investing today, who will be investing in 2030 in India, and if he or she doesn't make money, then he or she needs to be exceptionally talented. So are we already discussed around this, or I
No,
want
yeah.
to further the conversation
Yeah.
around this point.
No, I'll just add context to it. See, I think basically what happens is that the most celebrated investor in the whole world, most reputed investor in the world is, of course, Mr. Buffett. And it's a well known fact that whenever Mr. Buffett is asked that, Mr. Buffett, what is the secret of your success? In a very humble fashion, he says that the biggest success factor is that I was born in the USA in 1930. So, and you know that his investment career flourished through the 50s and 60s, and his investment career coincided with America becoming a superpower, right? So he's in a humble fashion basically saying that one of the key reasons for my success is right place, right time. So in that context, I mentioned in one of the forums that if you are investing in India's stock market through the 2020s and the 2030s, you are in the right place at the right time. But also, I would like to caution that I'm not trying to make a difficult task too easy. A lot of times, all our listeners also right now, when you hear that, okay, oh, this guy is saying we are in the right place at the right time. I'm not trying to say right place, right time is not about luck. Let's not conclude that. A lot of people were born in America in 1930. Everybody didn't become Mr. Buffett. The point is that, yes, if you're investing in India's stock market through the 2020s and the 2030s, yes, you are in the right place at the right time. But being in the right place at the right time is not about luck. If you are in the right place at the right time, you also need to do the right things. And for doing the right things, you need disciplined people. You don't need talented people. I think that is the key thing. See, right place, right time, doing right things means invest, remain invested. Don't get too carried away with every day, why did market go down? Why did market go up? All these kinds of things. Correct. So I think that was the context of, what I was asked and, why I mentioned that.
All right, sir. So we got one speaker, Venkat. You can unmute and ask a question to Ashish.
Yeah, sure. Thanks. Hey, Ashish.
Yes, hi.
So I have a question regarding personal finance.
Mm-hmm.
I started investing since last 5 years,
Mm-hmm.
and my friend is also there. He also started investing since last 5 years, but he invested in real estate.
Mm-hmm.
I invested in the stock market.
Mm-hmm.
So I made around 100% plus.
Mm-hmm.
But his investment is also went 100%. He invested 10 lakhs for a 50 lakhs apartment.
Mm-hmm.
He gave a down payment of 50
Mm-hmm.
lakhs, 40 lakhs he got a loan.
Mm-hmm.
Now the 50 lakhs became 1 crore. My 10 lakhs became 20 lakhs.
Mm-hmm.
But in reality, he made more than me,
Of course.
because yeah, because 1 crore out of 1 crore, only 40 lakhs is the loan. Remaining 50 lakhs. So 10 lakhs became 60 lakhs for him.
Yes.
But for me, 10 lakhs became around 24 or 5 lakhs. So, I was listening to so many CFAs, everybody was saying, getting a 12 to 15% in stock market is very greater than investing in a gold or real estate. So now, after these many years, I realized that I did a mistake. So what is your take on this, sir?
No, so Venkat, I don't see. Frankly, I don't know when did you join the call. Right at the beginning, I said that to be a successful investor, you should not be jumping to conclusions and you should not be deterministic. You should be only open-minded and probabilistic. So couple of things I can say, and there'll be many people, I must agree, there'll be many people on the call who will disagree with me. I will also talk with my personal experience and what I think. A lot of times people say, don't borrow, don't leverage, never buy a house, don't be in a hurry. All these kind of things people say. It's a different school of thought. People have different beliefs, different experiences, right? I personally think it is bad advice. I'll tell you the reason why. The world's most famous investor in real estate. So stock market, everybody knows it's Mr. Buffett. The world's most successful investor in real estate is a gentleman called Sam Zell, right? He used to own a company which he sold at the peak of 2007 to Blackstone for some almost 37, $38 billion at the peak of the real estate so-called bubble, right? Now, he made a statement which I had in fact put on Twitter a few months back. The only asset class where the bank happily gives you leverage is real estate, correct? But real estate also, don't draw conclusion based on what your friends did, because the point is that if you put 10 lakhs, borrowed 40 lakhs, property has become 1 crore. What if the value didn't go up at all? He would keep on paying the loan, he would get no appreciation and no gains. So don't draw conclusion based on what your friend experienced. But the key thing to learn out of this is not to apply one formula in all situations at all times. The point to learn about this is that there are no no-nos. The point to learn is that if it is done in a constructive and healthy fashion, then leverage is not bad. If we borrow and spend money on consumable items or buying a big, huge car, that is probably wasteful leverage or wasteful borrowing. But if you leverage and you buy a house and the value of the house appreciates, the fact is that nobody gives you leverage to put money in the stock market. But because a house is a real hard asset or a fixed asset, banks do give you leverage. And that's a reality that if you borrow at a certain rate and hold for a few years, and if the property value appreciates, then you can make disproportionate gains. I think the learning is about open-mindedness. Now this would be a wrong time to do what your friend did 5 years back, by the way. So keep it in mind that it's a workable strategy. Use it sometime in future when it is relevant for you, and just stay open-minded. Don't draw any conclusions.
Thank you, sir.
So, Ashish sir, lately seeing, the year 2020 had been not so good, and even the first half of 2023 appears to be more or less same. And even the non SIP contribution is decreasing.
Yeah.
So how you see, things going from here? How long this kind of things can sustain in the market? Obviously, not about predicting, but with your experience in the past, how you see market going from here, in the sense like if somebody is looking for say 3 5 and any good sectors which you are looking forward to.
So I think in response to a previous question with Kaushik, we did discuss a lot about sectors. But on your question, the previous part of your question, I think I can say with my interactions with investors, I can say 2 or 3 things. One is that obviously last 18 months, see, I have seen that, let me put it differently. Let me ask you an open-ended question. What is the opposite of love, right? Now, whenever you ask somebody what is the opposite of love, 90% people will say it is hate. That's the wrong answer. Love is a strong emotion. Hate is also a strong emotion. Opposite of love is not hate. Opposite of love is indifference. Why did I say that? Apply the same logic to the stock market. People are glued onto the market if it is booming, and people are glued onto the market when it crashes. But people become indifferent and the volumes become half and the SIPs start floundering when market goes nowhere. There are always people active when market is booming, and there are always people active when market crashes. But people start becoming inactive, despondent when market goes nowhere. And last 18 months, that is the challenge. In October 2021, we were 18,500. In November 2022, we were 18,900. In between, we have consistently been between 16 and 18. For a year and a half or nearly 2 years now, people have not made returns, correct? The small cap index has gone back where it was in January 2018. So what happens when people don't make returns? They start becoming disinterested and they start thinking, oh my God, it was better if I was in an FD or something, correct? But I mentioned somewhere in the call that you should be probabilistic in your thinking. So what does probability say? if you have not made any returns in the last 2 years, people start concluding this is a useless place, kuch nahi hone wala hai, nikal jate hain. But what does probability say? That if you have not made returns in the last 2 years, the probability that you will make returns somewhere in the not so distant future, that probability actually goes up. Let me put it differently. We tell people that when you're investing in equity, you should invest 5-year plus, right? And people say that, long period average of stock market is 12 to 13% compounded. It's a fact. After liberalization from 91 till now, Sensex has compounded 12 to 13% year on year for last 30 years. If I put a riddle और मैं एक पहेली दूं आपको that long period average is 12% compounded, you invest in Sensex only, long period average of Sensex is 12% compounded, you have to invest in Sensex, but you have to get more than the average of the Sensex. Then what will you do? Mathematically, if you invest whenever the recent average is well below 12, then somewhere in the not so distant future, the average has to go above 12 for the long period average to settle at 12. The other way to put it is, a lot of time people are told that, you should invest for 5-year plus. So let's look at last 5 years. In last 5 years, Nifty has gone from 10,000 to 17,000. So in 5 years, it is up by 70%. It must be 11, 12% or some such number compounded in the last 5 years, which is not very high, but not poor. It's decent. But do you know that in the last 5 years, 5 years started in March 2018. From March 2018 till March 2020, market went nowhere. It actually crashed. Correct? So out of 5 years, first 2 years, you went nowhere. You were traveling in the wrong direction. It went nowhere for the first 2 years. In these 5 years, last 1.5 to say 20 months, again, market has done nothing. In the last 5 years, the entire return was made only between March 2020 and September 2021, which is 18 months. So in the last 5 years, entire return was made only in 18 months. But who entered in March 2020? Practically nobody. Very few people. Correct? So the point is that in any 5-year time frame, your entire return will come in 18 to 24 months. The problem is which 18 to 24 months you don't know. That's the challenge. But only thing you know is that whenever you have not made returns in the previous couple of years, the probability that you will make good returns in the next 2-3 years, that probability actually goes up. That's the only thing to keep in mind. So if you have done an SIP in the last 2 years, it has not given you any return, keep in mind that somewhere in the near future, you're going to make very good returns because the average has to tend towards the average. That's the key point to keep in mind.
Right, sir. And also, like when it comes to emerging markets, we cannot ignore China. But the China plus theme is one thing which has been, the talk of the town. So, are we really extrapolating this, or I were to ask you on ground situation, or is it really happening big time, or it will take its own time? How you see this?
No, see, look, there'll be far more qualified people, who are industrialists or who are into manufacturing, who are really on ground, who will be more qualified to answer this than me. But yes, we do meet, my colleagues, we have a very large research team of 37 people. So, and, there are like 4 or 5 people who cover every sector and, whatever I'm telling you is second-hand knowledge because it comes from our research analysts and our portfolio managers. And I can also tell you that there are people who are more qualified than me to answer this. But 2-3 things that we must remember. I think China plus one and whatever happened after COVID, I think COVID was just an event which might have highlighted the need to diversify the supply chain or to make alternative provisions. But COVID or no COVID, in any which way, if you look at the reality, the fact is that China's population is degrowing, right? They are becoming older and older and they are started to degrow. And for more than 40 years, they had one-child policy, which means they cannot suddenly reverse the population, correct? Now, the point I also mentioned somewhere in our long call, in this long discussion somewhere, I also mentioned that returns are always made on growth. And people will invest where there is growth. Also, please remember that growth is always some function of population and productivity of that population. So if we have our own challenges, but the reality is that if we have a large scale population and good part of that population in the age of in a productive age, and if private as well as public put together, we can invest to improve the productivity of that population. So what does the government do? Education policy, PLI, uh, you know, ensuring that all the manufacturing and technology transfer happens into our country. People are not just assembling, but also investing and bringing technology, etc. A lot of these things the government is doing is to enhance productivity. So all things put together, and without making any conclusions or without taking anything for granted, suffice it to say that next 15-20 years, we have a good shot or a good chance to be one of the key driver or key engine of growth. That's why I also gave some back of the envelope arithmetic. Always keep an eye what percentage of the world's annual output are we contributing, right? In 2022, we contributed north of 20% of the world's incremental output. So that is what drives investment decisions. So long story short, I think COVID was just an event which highlighted or maybe even a little bit preponed what was eventually anyway going to happen. But now it is for our country and our government and our people to capitalize on a particular opportunity. So I think that is what we should watch out for. And yes, next few years look exciting. So we should be looking at it constructively.
Right, sir. Although we know you do not do direct investing from last 2 decades, especially on your own. But again, if I were to ask you about your self framework, or maybe what could be an ideal self framework with your experience in the market, so what would be your take on this?
See, yeah, like you rightly pointed out, I don't buy and sell stocks because it's a conflict of interest, right? If I tell people that they should put money into portfolio management or mutual funds, and if they find that I'm myself buying and selling stocks, that will be the biggest disconnect. Secondly, obviously, we operate in a regulatory framework, so we should not be investing directly into equity because also there is a chance that you would be you should not, I mean, you'd never want to be anywhere uh, in any kind of conflict. You never want to be anywhere close to any regulatory borderlines. So I never invest in stocks. All my investment, my family's investment is where our clients invest, which is into our PMS and mutual funds and those kind of things. And frankly, it's not something which I'm saying about myself. I think by and large, I know that in the industry there are a lot of my colleagues, they practice exactly the same thought process, right? So yeah, I mean, so if you ask me my framework, I invest in PMS or mutual fund, and I have always invested in. I have not worked in too many companies. I worked only in two companies till now. Previously, it was ICICI. Then for 8 years, it was MO, and now it is Whiteoak. So I have invested wherever I have worked for. So I don't have any personal stock picking or personal framework. I invest where our investment team, invests in our own products.
Right, sir. So I was asking about the self framework. If you can touch
You
upon
mean sell,
because,
SELL?
yeah, self. Yes, yes, right.
See, I think in our, so let us say in our equity portfolios, if we are holding a bunch of stocks, I think selling is determined, I think, three ways to look at it. One clearly is that, you know, if we think that, whatever framework our team does for valuation of companies, if they believe that there is more value in certain other parts of the market or in certain other stocks, and if they believe that on a relative basis, certain stocks have done what they could at least for the next year or two, because see, ultimately what happens is that long period average for Sensex is 12% compounded, correct? So over long period, if you want to beat the benchmark, right, then you need to do much more than that. But stock market actually doesn't work that way. There are certain months or quarters or years, certain times stocks give next 2 years return in 2 months. So the point is, one clear thing is that, because we would aim to beat the benchmark, so we should be valuation conscious. So which means if we see that something has become expensive and maybe on a relative basis, there is more value somewhere else, then of course something has to be trimmed and something else has to be bought into. Second clear thing is that every time we are not right. Sometimes every time you buy a stock and whatever valuation, etc., that you do, all said and done, you're hypothesizing the future cash flows of a company. And it's not necessary that every time it will play as per your hypothesis. Maybe sometime you miss something, maybe sometime you need to take corrective action. So of course, if we are wrong, we have to sell. And the third is, clearly, if you ask me, sometimes there could be some changes, management changes, key personnel changes, some macro changes. The environment, makes certain businesses to face adverse circumstances. So maybe some fundamental changes could also necessitate that. So yeah, I mean, myriad set of reasons why one would get out of any position, really, if you ask me.
Right, sir. So last two questions from my side, Ashish sir, and
Maybe we can close with that, whatever last couple of
right,
questions.
sir. So a few mistakes which you did in your journey and want to talk about, and the most important aspect of market is behavior, right? So any good books or maybe any good ways so as
Yeah.
to condition the behavior to our advantage so that our decision making gets better.
So I can tell you one mistake, which I made very early in life, when I was still studying. When I was studying at that time, I was, while I was studying in my B school, I was also a trainee, and, earning some stipend, etc. So at that time, it was the whole tech boom. And that was the time when I didn't have all this discipline that I should invest where I am working, and, all those discipline. And maybe I was a youngster, 21, 22 years old. So I, based on some recommendation from one of my college seniors, when the tech boom was on, I bought into this company called Mascot Systems. Okay, let me clarify. It was not Mastech. If it was Mastech, then even I would have some fancy stories to tell. It was not Mastech. It was a company called Mascot Systems, which then, got sold off and went through myriad set of M&A activity. And, then I think ultimately merged with one of the companies. It doesn't exist today, by the way. So obviously I lost, few months of stipend went down the drain. So that was my first experience of directly investing with equities. I still remember the name of the company. And, I lost everything I invested even when I was a trainee or I was a student. So that was one thing which I've never forgotten. Right. But yeah, I mean, you mentioned about, books, and I love reading a lot. So one of the books, because you have written something about multidisciplinary investing out here, and Mr. Charlie Munger also says that, thinking should be in terms of, lattice work of mental models. And, we gave some examples of how to visualize the stock market. So, I have seen that whenever you are not able to understand some phenomenon, then if you try to draw parallels from other sciences or from other modes of thinking, it helps you to simplify complex things. So I read this book which is called Investing, the last, Investing, the Last Liberal Art. It's written by Roger Hagstrom. So I think that is something which is really, really worth reading. It's one of my favorite books. The other one is, Influence, the Art of Persuasion. That is by Robert Cialdini. So I think some of these books, I mean, if you want to learn about behavior and if you want to learn about stock markets, you don't have to read about stock markets and fundamental investing. You can read about multiple things. You can read about business, and I think investing and stock markets is something that you will find parallels everywhere. There are parallels everywhere, actually.
Right, sir. So thank you so much for your time today. It was really insightful, and sorry on my part for the initial glitches. I missed the most of the part. I myself would listen to the recording, and thanks Kaushik for handling the situation during that time. So Ashish sir, before we close, any short closing remark for our attendees? Although you have covered all the aspects holistically.
No, I would just, out of all of these things, I would just sum up one thing, which is that to be a successful investor, you should be probabilistic and not deterministic. I think be open minded, don't jump to conclusions. I think those things are very, very important because, investing is a journey, it's not a destination. every time the market falls, you don't have to conclude that it's the end of the world, because that is what human beings do. They swing to extremes. In March 2020, the popular sentiment was, okay, this is the end, human beings are the next bunch of dinosaurs. And in some other time, when market is booming, people start thinking all trees will grow to the sky. The reality is always in between. All trees don't go to the sky, and human beings are not even going to become dinosaurs. So I think never think on extremes. If you can be probabilistic and avoid being deterministic, if you can be open-minded and open to possibilities instead of jumping to conclusions, passing judgments, you will do much better. That's what I would share. Thanks for inviting me. I hope I was able to add
Thank you.
some value to all the people who
Indeed,
spend so much time.
indeed, great value, sir. And the last point you made, I can totally relate with the example of lift and the train which you use to commute from your place to workplace. So for our attendees, like if you type search name on YouTube, you will find many good interactions and real examples, so as to make the investing understandable and easy to sail through volatile times. So thank you so much once again, sir. It was great having you today, and surely look forward to more interactions as and when time allows. Thank you so much.
Obliged to you. Thank you. Obliged to everybody else. Thank you. Thanks for joining.
Thanks, sir.